Hey guys, in today's video we are going to look at Intel stock, and Intel is also a chip manufacturer competing with AMD, Nvidia and others. You can also watch my latest video about AMD stock, and Intel has a lower PE than AMD but also less growth potential. So let's start looking at the graph. As you can see, it has gone up in the dot-com bubble and crashed and not gone up to the price it reached in the dot-com bubble. But now it has crashed a lot from $68 to $25, and it seems like it's going up again. The question, we also see that it has gone down, so it's maybe it's at a discount, so let's look at the financials. First, we want to see rising revenue, and as you can see, it stayed almost the same over the last few years. It has gone up until 2021 to 79 billion, but has declined to 63 billion. In this case, I would also look at quarterly revenue growth, and it's still going down right now. So I would recommend you to wait maybe until it's going up again, because I'm a bit bearish right now on Intel, because I'm not sure if it will grow again or if it will go down from here. So I would wait until revenue is growing again from quarter to quarter, maybe. Net income is positive but has also gone down a bit since 2021 or even before that. Shares outstanding have gone down but have gone up in the last few quarters, which is weird because the price is so low. Let's look at quarterly data, and as you can see, it has gone up since quarter 4 of 2021, quarter 1 of 2022, which is the time the shares were undervalued. It hasn't gone up that much, but still something you should look at, because we don't want to see that with undervalued low PE stock, shares of the company. Now let's look at cash flow. Cash from operating activities has gone up and now it's going down also. And free cash flow is negative. So what does that mean? Why is free cash flow negative? One possibility why it's negative is because they are investing heavily in factories, and they are spending they are spending much money on capital expenditures. Yeah, as you can see, they've increased capital expenditures from 9 billion to 25 billion. I think that also includes factories and stuff like that. Like they are building many factories around the world in different countries for producing chips, which is something I think is a good idea to make some extra revenue and income. But yeah, you should be careful about that, because they also pay a dividend, I think, and with negative free cash flow, maybe they should drop the dividend. It's $1.4 per share, which is 5% at the moment. They've also, I think, dropped it a bit, but I'm not sure right now. Yeah, if you want a dividend, it's also a good dividend stock, but at the moment with this negative free cash flow, they will probably make more debt because they have to raise capital and pay out dividends. Okay, now let's look at the debt. It's 42 billion. First, let's look at if they have debt, because they have less money than debt, so their net debt is positive. 14 billion, and their total debt is 42 billion. And can their income sustain this debt? Yeah, kind of. It's in the realm of possibilities. So it's not they don't have that much debt compared to their income. Now let's get to calculating the value of Intel. But first, let's look at some bull and bear cases about Intel. The bear cases are that Intel hasn't invested as much in their chip making business in the last few years, and AMD has overtaken them. And the difference between AMD and Intel is that AMD doesn't have its own factories. But I think that's a good thing for Intel because it's better to have their own factories. But the bad case is that the factories are worse than the Taiwan semiconductor manufacturing factories. But also some bull cases are that they want to expand their factories to external customers like Samsung or AMD even, who can order their own chips from Intel in that case, and that they will get maybe some money from governments, but I don't really think that's a bull case. But it could be good for their business, so you should think about that. But now let's get to the numbers. First we will look at this model. And we'll start by putting in revenue of 63 billion. Revenue growth of, in the worst case, I would say negative revenue growth. Does this model even account for negative revenue growth? Minus 5%. Profit margin, yeah, it accounts for that, but minus 5% is a bit much. Minus 1% maybe. Profit margin of around 10% in the worst case. This is really the worst of all cases in this case. PE of 10. Okay, and in this case the buying price would be $3, but this is really the worst case with lowest profit margin and so on, and no dividends and stuff like that. And our revenue would decline to 56 billion. So now let's take revenue growth of 0% and maybe profit margin of 15%. It can even go up to 27%, but that's a bit higher, I think. And price to earnings is around 10. I would leave it at 10, to be honest. In this case, $6 would be a nice buying price. So now let's give them some revenue growth of 2% maybe. 76 billion, let's say 3% revenue growth would make the revenue go up from 64 billion to 84 billion. That's more reasonable. In that case, you would have a buying price of $8, around $8 per share. So to be honest, I'm more agreeing with these assumptions right now, even though I was a bit bullish on Intel, but I'm not convinced right now that they will grow that much. A nice buying price I had in mind was $25, around that area. But let's take some more bullish assumptions also to have some different opinions about Intel. Let's look at 5%. Yeah, 5% would be the highest I would go with revenue growth. And profit margin, in this case, it would still be a trash investment. Profit margin of maybe 20%. I wouldn't go higher than 20% in such a competitive market. So I would buy it at 13. But let's put in the highest assumptions. In this case, the highest assumptions would be 27% profit margin. I wouldn't go higher than that. This would give us a buying price of $18, which is still not that nice, but with these assumptions and maybe a price to earnings of 15, which is still high, so I wouldn't take that. It would give us a buying price of 28, but let's leave price to earnings at 10. So in this case 18 would be our buying price. So if you agree with these assumptions, you should buy Intel at 18 if you want to make 15% per year. Now let's look at our other model for calculating the price of Intel. In this case we would also put terminal value of 10. Growth rate, we could look that up. On Yahoo Finance, we can go down and see 8% growth rate is expected. So we'll just put that in, 8%, 4%, 15% free cash flow in year one is, let's put in 9 billion because negative wouldn't be really smart. So let's put in 9 billion. Stock-based compensation is around 3 billion, 30% of the free cash flow. Debt is minus 14 billion. And shares outstanding is 4 billion. 4.1 billion. This would give us a buying price of $13 and a current margin of safety of minus $179. So in this case, even the cash flow valuation model is saying Intel is overpriced. So I would recommend you to maybe wait until it gets lower, or to maybe invest in Intel with low assumptions of growth. It's a good dividend paying stock probably. You could use a dividend valuation model to calculate the value you could get with Intel. But at the current price I don't like it really much, and with the current growth of their revenue and income I also don't really like it very much. I would wait for it to get some positive quarters of revenue growth, and maybe then you could look into investing. Or maybe you have a different opinion and think Intel will go up to more than 100 billion of revenue, which is a bit unlikely, but everyone has different valuations. So think about which price you would buy Intel for. Mine would be probably like 20 or 18 right now, not 25 anymore. Even lower than that probably, but maybe 18 would be a good starting price. So if you like this video, give it a like, and bye.